Welcome back, episode 17 of Making Sense of Your Money. As we film this today, March 30th, I would assume that most of you have just completed your taxes or are almost done getting your taxes done. So I wanted to just come on and say, like, what should you be doing with that information? And the answer is probably not sticking it in a drawer for a year until next year. So, when you look at your taxes and you pull out Form 1040, there's a few things that we think are important for you to take a look at. So first of all, capital gains. Elizabeth, why is that important to people, or why should it be important to people to look at that?
Sure. So the capital gains, I think, are important regardless of the tax year, but probably even more maybe important after a year like last year. I had a seminar just a couple of weeks ago where I had someone raise their hand, and what he asked me was, is this possible? Is it possible that I have a gain that I have to pay tax on when my account was down last year? And the answer is, yeah, it is possible. The reason being is capital gains can be a little bit complex to think about. But if you think of it just in the sense of accounting, basically you can own a position all year long. Maybe it's a mutual fund that you're holding inside of like a brokerage account or whatever it may be. And point to point, from the beginning to the end of the year, you may actually be down in paper dollars on that account. However, throughout the year, there may have been trading inside of that portfolio, which may have resulted in a security being sold for a gain. That does have to get passed on to you, the end user, the investor. That's part of that accounting process. So yeah, it is possible that you could have a capital gain in a year where your account was actually down, and then therefore you pay tax on that. If you're in that situation and you're not very happy about that situation, talk to somebody, talk to us. There are many types of accounts out there that are not necessarily looking at being efficient when it comes to taxes. They're just looking at the investment as a whole. But on the flip side, there are a lot of things out there that you can do that are efficient, certain accounts, certain strategies that are looking at those accounts and trying to figure out how do we be as efficient as possible so that maybe you don't have those huge outlier years like a year like last year where the market is down substantially. And then in addition, you have to pay capital gains tax.
Yeah, paying taxes just no fun. So the next line that probably no one's had to really take a look at for 10 or 12 years is the interest line.
Yeah.
So why should people be looking at this? Why is that important?
Sure. So when it comes to the interest line, in the past, maybe it's been dividend interest or other things for your taxable line, but your short-term banking, checking, savings, things like that, unfortunately, you have not probably had anything to claim for quite some time, just because interest rates have been on the ground. Last year, interest rates started to rise. You should, hopefully, if you have what we call that kind of like lazy money that's just sitting in savings types vehicles, those short-term vehicles, hopefully you are gaining interest on those. And if you're not, it's time to start looking. So, we don't necessarily handle these in-house, but we certainly recommend them for clients. One of them just being is online savings accounts. You're looking at online savings accounts out there. There's lots of options. They're paying right now between 3 to 4% interest.
Yeah,
they're fully liquid. There's generally no fees. You also get your FDIC insurance with those. So I would definitely look at those avenues, especially if you're still in maybe a traditional type brick and mortar bank for a lot of that money and maybe only getting, pennies on the dollar. There's also CDs. So again, a lot of these higher rates might be in online vehicles. And we've seen some that are even penalty free, meaning that you can get between, again, that 4 to maybe even 5%, depending on the company, depending on the term, and you're going to get that. And some of them you can even break without penalty. So if you're in that situation where you have money kind of on the sidelines or money that's just kind of in your safe, kind of under the mattress money, but it's in a bank, definitely start looking for other places to put it and put your money to work for you.
Yeah. So like next, if you're one of the lucky ones that's retired, receiving Social Security, what should you be looking at for that Social Security line on the 1040, the Social Security income, I should say, on the 1040 form?
Yeah, a big thing that clients have concerns about is how much of my Social Security is going to be taxed.
Yes.
Social Security, it's basically a tax, right? Throughout all your working years, you put into it, and then you might have to pay tax on it when you take out of it. So how much of it's gonna be taxable is based upon what's called your provisional income. But in essence, if that provisional line, if you are a single individual, is under 25,000, 0% of your social security is subject to tax, which is great. Once we get to 34,000, basically in that window, up to 50% subject to tax, and then finally over 34,000, 85% of it is going to be subject to tax. Married individuals, unfortunately, we're not double that number. What you're looking at is you'd have to stay around under 32,000 in provisional income for your social security to have 0%. 32 to 44 is going to be up to 50%, and then over 44 is up to 85% of it is going to be subject to tax.
So when you're looking at social security taxes and, in social security income, what else can that affect when you're looking at that?
Yeah, so that provisional income is really, it's a factor of your adjusted gross, and there's, like I said, some deductions and things that's why they call it provisional income, and that determines how much your social security is taxable. But what people don't also realize is that adjusted gross number can also spill over into having some kind of penalties, I guess I would say, in other categories. Probably one of the biggest is going to be your Medicare premiums. So your Part B and your Part D premiums are going to be subject to what's called IRMAA, your income related monthly adjustment amount, which is a mouthful. But that's based upon what your tax lines were 2 years prior. So it's really important when you're looking at your return, especially as we're getting closer to 65, really starting at age 63, potentially, if you're going to be on Medicare at 65, is taking a look at what that income line is for your adjusted gross and understanding how that's going to affect your future premiums. Because when it comes to IRMAA, what they look at is 2 years back. Why not complicate things, right? So, potentially if you're 63 and you're working, you're maybe in your highest earning years, maybe you sold some company stock or some other things that is bringing up that income line. And then at 65, when you need your Part B and Part D, you may be penalized for that income that you had. So, this all plays into each other, Jeff. And that's like really what we do, right? When we're working with clients, if you're listening to this video and you have questions on this, these different categories, is reach out, because our job is to work with your accountant today to figure out how do we make sure that what we're doing is appropriate for you in this current tax year, but also, and maybe even more importantly, is what are we doing today and how does that affect what our tax situation is going to be, whether it's the 2 years ahead for IRMAA or the potential social security tax that we're going to have later on. And that's where this really comes in together is just the planning and trying to look at, what our focus is, which is retirement income distribution planning.
So I know that was obviously a lot to digest. So like Elizabeth said, if you do have questions, please reach out to us. We are more than happy to work with your accountant or refer you to an accountant if you don't have one that you really like. So please, again, reach out to us, set an appointment via our Calendly link. Check out these videos, our past videos on our YouTube channel. And as always,
go Bills.